Welcome to my economics channel, where I love discussing the subject, but most importantly, I love to make something fun and interesting to learn. And to that end, I want to bring up the recent rise and fall of the GameStop share price as a way as a way of analogy to how we understand modern economic growth, or indeed just economic growth in general. So the details behind the GameStop share price rising and then falling, and including other companies as well, they participated. It's just that GameStop got the lion's share of news around it. The details behind that are not particularly interesting for this channel. I focus mostly on economics, but I will provide links to where you can understand more of it. However, what is interesting is the story behind it. We have this massively well documented event happening before our very eyes over the course of admittedly a few weeks, but you couldn't possibly escape it in the news cycle. But what was most interesting about this singular event was the differing stories people had about it. This is an event that people covered in excruciating detail, and yet we still had differing ways of seeing it, different narratives, different stories. So broadly speaking, on the one hand, we had this sort of everyman or everyday investor or simply the average investor on the one hand, and they're participating in this massive market rally, or at the very least a rally of a number of stocks, and they're making money. On the other hand, we have the short sellers and we have the financial system in general, where this is basically just business as usual. There's nothing particularly unusual about this, except that it's something that happens every so often, and it's something that's going to happen again into the future. So on the one hand, we have people that think they're taking on big institutions, they're taking on these big, bad, scary companies, maybe evil companies even, in the form of these hedge funds which are shorting the stock. And I believe that most of these people form their opinions in large part due to how the global financial crisis played out. Now, not to get bogged down in detail, but the public perception, at the very least at the time, was that rich people got out fine during the crisis, or at the very least after the crisis, when the stock market began its long tear upwards. And the rise of the stock market was essentially seen as a rich man's game. The everyman, the average investor could not get in, or at the very least didn't get in at the time. However, this time when the stock market was going up, people were taking their chance to pounce and then ride this new stock market wave. I believe most people that thought they were taking the fight to these big hedge funds were sincere. And so in particular, when Robinhood stopped people from buying the shares, I believe it was over a Thursday and a Friday, when the price reached roughly $400 mark. That was seen as a massive slap in the face against these ordinary investors, but it was also seen as almost like a declaration of war. It was almost seen as like the New York banks, the New York financial sector, or simply the financial sector as a whole, fighting back against the little man, and it vindicated the fight that these people thought they were in. And so to that end, we have the following from Philip DeFranco, who says,
while Robinhood is not the only company to make this call, right? More traditional brokerages like TD Ameritrade and Charles Schwab have also restricted some forms of trading. It just feels worse with Robinhood. I mean, they've built their whole identity around this idea of democratizing finance for all. And so that's why a lot of people, including myself, are pissed. Which is why I'll say, one, as a longtime Robinhood customer, I'm fucking furious. I'm moving my money. And two, in the past, they've actually had spots on my show. And so let me make this very clear. I'm not suspending future Robinhood spots. I am completely canceling them. And I don't care how much money I got offered. I'm not taking them back on. But when you make it so that people can only sell, and you're widely seen as the brokerage for the everyday person, and this whole movement has been charged by the everyday person.
Now, I only pick Philip DeFranco because he typifies this side of the argument. Now, we have a more middle of the road argument, if you will, in between these two extreme camps. And the argument, without going into too much detail, is this. People were placing their orders with Robinhood. However, at the end of the day, Robinhood has to be able to put up the money to actually purchase those shares. See, Robinhood doesn't own the shares, it purchases them afterward. And it does it through Citadel, a really large financial institution. And the thing is, with the sudden large influx of people coming in and placing these orders, Robinhood simply didn't have the money to execute those orders. It needed to borrow money. And it did borrow money in the previous days before it locked down trading, but it simply wasn't enough. And on the day that it locked down trading, it projected they would need to borrow, I think it was about $3 billion. And it simply was not able to do that, and so it shut down trading. But the thing is, Robinhood was not the only one that did it. Other exchanges stopped trading as well. And so why did so much media attention, why did so much consumer ire get directed at Robinhood? Well, part of this plays into what I'm saying in this video. Public perception matters. And so the public perception around Robinhood, and in particular the way it shaped its marketing over the years, was that it was for the everyman investor, for the average investor to get into the stock market and participate in the stock market gains. But when it suddenly closed trading off to GameStop and the other companies as well, that was seen as an attack against the very people, the very constituency, if you will, that it was meant to serve. But then we have all of these different views which are shaped by our own experiences, and those views become our reality. The way we viewed Robinhood, the way we viewed the financial system, the stock market, the financial sector after especially 2008 and the global financial crisis, that helped shape our opinions. That helped shape all of the events that came together, all of the conditions that needed to be right for this event to play out in front of our very eyes. And the reason this is interesting is that this helps inform some of the big disagreements we had of economics in the past, and in particular economic growth. And we can look at mercantilism as an example. Now, previous to the writings of Adam Smith, David Ricardo, and others in the 17th century, the big idea was that what you wanted to do as a country, you wanted to export more than you imported. The idea was that you had all the production at home, you did all of that, and then you exported and you brought in more gold and or silver, although it's predominantly gold. And for technical reasons, including the labor market, employment, price stability, and all that, you wanted as much gold at home as possible. Now, of course, when we think about the world as a whole, it's impossible for every country to export more than it imports. And so famously, or infamously in the case of Britain during this period, it used its navy and its army to enforce unfavorable terms upon other countries, to then force those countries to import, to only buy from England. Because England at this time, surprisingly enough, was not actually particularly competitive when it came to the overseas markets. And so to that end, mercantilism wasn't defeated overnight. It took many generations and many great thinkers to come to the fore, to write about it, and to help shape people's opinions and then eventually public policy. But this might surprise you, economic growth in England really only took off after about the 1850s. Before then, economic growth was actually surprisingly small, given the vast increase in manufacturing at the time and the vast increase in output. And what started to happen was that England didn't need to export more than it imported. It didn't need to force unfavorable terms of trade. What it needed was more internal growth. Now, if we think to the modern US, it has the exact opposite situation. The US imports more than it exports. So the US exports more money, but then it imports a lot of goods and services. And this allows many people in the US to live very good lives. And then the US can have a larger service sector. And so to give a really simple example, we can think to the Roman Empire. And we can think to the famous map of Rome at 117 AD or 117 CE, depending on exactly how you use the date system. But at this time, Rome was at its maximum territorial extent. And the idea is that Rome had to grow simply to feed a higher population, because the way people farmed didn't change all that much, and output per farm didn't change all that much. And so what happened was that because a given farm couldn't produce more food, well, the only way to produce more food was to simply get more farms. And you get that in part by conquering more lands, bringing more farmland under cultivation. And this is an expansion, this is extensive growth. But this is only possible for a short amount of time. And this is in part what brought about the downfall of Rome. It stopped expanding. It couldn't keep expanding. It couldn't support a higher population. And then this in part, alongside the lack of technological growth, is what helped bring about the downfall of Rome. But in the vein of this video, let's go on to another topic. What about modern monetary theory? Now, once again, without going into details, because the details don't matter too much, one of the big tenets of MMT, and in particular the proponents, they always bring this up, that especially since the crisis, but even since the 90s really, the deficit in the US has exploded, public debt has exploded, money printing and all that jazz, all of that has happened. There's been almost no inflation. In fact, for most advanced economies around the world, inflation has been largely muted. For most countries, it's under 2%, whereas the mandate is generally 2%. And central banks have had a hard time of hitting this target. Now, it seems a bit funny to say it's hard for the central bank to hit a 2% target, a 2% level of inflation, which ultimately erodes our real wealth and our savings. But there are many other things that go into the inflation rate. But the big thing is that deflation is really bad. But the point here is that proponents behind MMT can only have this idea that we can continue to run deficits, that deficits don't matter, that we can continue printing money, we can pay for these great big projects in society, we can do all these wondrous things, the government can borrow for nearly 0%. It can only have this opinion because of the way the economy, because of the way macroeconomics has played out in the last few decades. Certainly, no one had this view back in the 70s with the great inflation, when the inflation rate for many advanced economies around the world was around 20%. But the reason I bring all of this up is that people can have this viewpoint only because a confluence of events in the last few decades have come together to help create the environment that we're in now, the low inflation environment. But it's not suddenly true that we can print money with abandon and there's not going to be inflation in the future. There are still constraints on the economy. It's just that it looks like there are no constraints on the economy. It looks like there's slack, as in that we can employ more people, that we can run the economy what they call hotter, that more things can be done, more things can happen, there can be more economic activity. But that's the thing about MMT, there's no models, there's no hard data to go behind. There's only this idea, there's this sense these people feel that they're correct, and that sort of plays out before them because we're still in this same environment that started roughly in the 90s. And so given all that I've said, it takes a lot of reading to understand all of the events that came together to help produce the low inflation environment that we're in. And of course, not many people are going to do that much reading. But funnily enough, as a way of contrast, we have this article which says, "The money supply is growing, but money is still tight." And in the first paragraph, the author says, "I argued in a recent column that low interest rates, even persistently and very low interest rates, do not necessarily indicate that money is loose. Low interest rates are in principle compatible with money being tight, and in practice they are compatible with money being tight today." And so the basic tenet of this article, written in 2020, was that we needed to do more stimulus. The stimulus was not big enough. Now, of course, you might be saying that I might have disproven my own point and that I've proven the MMT is correct. But the thing with articles like this is that it doesn't just play into one idea. This actually looks at the data. It looks at the way history has played out. It looks at recent events and then forms an opinion. But this is different to the dogmatic approach that certainly I've seen of certain MMTers. And in particular, in the final paragraph, he says, "The money supply should change in response to demand. Inflation should fall when productivity rises and vice versa. There are excellent reasons to think that monetary policy should aim for spending to grow at a steady rate. If it is instead rising at a faster rate than what it usually does, as in the late 1970s, then money is too loose. If it is rising at a rate lower than previously expected, it is too tight. That is where we are now." And so the idea behind this article is that changing circumstances brings around changing data, and then we should change the way we think and act in the economy. Now, I don't just bring this up just to shit on MMTers, even though that's fairly fun to do. Now, my point is that as a common consumer, forming an opinion about how the world works, and in particular about how the macroeconomy works, how we should be acting and all that sort of stuff, that's extremely difficult. And this is why stories help us in our daily lives. And these stories shape the way we act. And these stories ultimately can shape the way the economy runs. And in part, this is how central banking works to shape our behaviors in the aggregate, at least in the short run. In the long run, the economy is going to do what the economy is going to do. But in the short run, central banks have a surprising amount of leeway in how they mold and shape our behaviors. Principally, of course, using interest rates, but there are other mechanisms that the central banks employ on a day-to-day basis. And so the low interest rate environment that we're in today, that helps shape people's behaviors in the aggregate and shapes people's expectations for the future. But it's not as simple as a central bank pushing down a dial to a really low interest rate, and then this influences people, and that this is suddenly the new interest rate for the economy. It is the fact that many things are coming together at once. It's low productivity, it's lower technological change, lower population growth. All of these things are contributing to the way people are acting and reacting in the economy. And the way people are acting and reacting in the economy helps push down the natural rate of interest. The economy needs a lower rate of interest than what it needed in the past, and then the central bank must comply. And so yes, the central bank influences us with interest rate and other monetary policy tools, but we in turn influence the central bank. But the story people believe about the economy, the story of Robinhood, the story of GameStop, the story of the global financial crisis, the financial system, the banking sector, all of that, even in what might be a very small way, shapes the economy going forward. that shapes our reality, that forms the reality that we will have while going forward. These stories matter, and that is ultimately what I wanted to get to in this video, and that is what I find so fascinating about the events that played themselves out recently. We have recordings of everything that happened. We have people going into minute detail about what happened. And even with all of that, people are still forming different beliefs about the event. However, this will shape people's opinions, regardless of how the event actually went down. And you might be asking for a more concrete example. Well, the distrust people already had for the financial system, especially after 2008, played itself out in the formation of Bitcoin. Now, maybe not in the formation itself of Bitcoin, but certainly its popularity. Bitcoin and the other related coins are seen as a way to circumvent the traditional financial system, the same system which is seen as only serving the rich and then leaving the poorer people behind. And this sentiment that people had towards the financial system is what allowed a company like Robinhood to come to the fore, and which is what of course allowed it to get into trouble with the events that play themselves out. And it's what makes economics so much more interesting than the way it's often portrayed in the media as this sort of ivory tower thing where you sort of have the profession up here and then all of us plebs, we're down here and we're getting taught something by these people who have studied extensively for many years, and they're sort of telling us how the economy is working, how it should be running, and all of that sort of stuff. The study of economics is so much more interesting, so much more democratic than that. And that is ultimately what I mean by my intro about making economics more fun and interesting to learn. But that's all I wanted to say in this episode. Thank you for watching. If you liked this video, leave a like. If you really liked it, subscribe. That really helps my channel, helps me grow, helps me reach more people, and ultimately one day make money off my channel. But thank you for watching, and I'll see you guys in the next episode.